Hello, fellow risk takers, and welcome to my worst investment ever. Stories of loss to keep you winning. In our community, we know that to win in investing, you must take risk, but to win big, you've got to reduce it. Ladies and gentlemen, I'm on a mission to help 1 million people reduce risk in their lives. To join me, go to myworstinvestmentever.com and sign up for my free weekly Become a Better Investor newsletter, where I share how to reduce risk and create, grow, and protect your wealth. Fellow risk takers, this is your worst podcast host, Andrew Stotz from A Stotz Academy, and I'm here with featured guest Vincent Deluard. Vincent, are you ready to join the mission?
I am looking forward to join the worst podcast in the world. I hope to be the worst guest as well.
Well, you know, that's the great thing about calling yourself the worst. We just don't have that much competition out there. But let me introduce you to the audience. Vincent is the global macro strategist for StoneX Group, where he authors weekly commentary on global macro topics and advises pension funds on asset allocation. Prior to joining StoneX Group, Vincent served as Europe strategist for Ned Davis Research, where he created the firm's Europe product. Before that, Vincent was executive vice president for Trim Tabs Investment, where he headed the firm's quantitative research. Vincent is frequently quoted in the Financial Times, the Wall Street Journal, and Barron's, and is regularly on Bloomberg TV and CNBC, and you'll also find him on many great podcasts. Vincent, take a minute and tell us about the unique value that you are bringing to this wonderful world.
That is a hard one to answer without sounding like a pompous fool. I don't know if I bring a unique value to this world. If I were, I think it might be the a keen sense of history, a passion for economic history, and some sort of a attachment towards money. I grew up in France, middle class family, teachers. This was not what I was supposed to do. I was supposed to be work for the French Foreign Service, and kind of fell into finance, mostly out of curiosity about how the world worked. And the more you study history, the more you understand the centrality of finance, and you understand how pretty much everything has roots in financial crisis. So that's what got me in there. I work at a very large brokerage, fantastic people, worked on Wall Street before, and but I'm not motivated by money itself. Like, I don't have angst over the monthly bonus, or and I know these a lot of finance people. There's nothing wrong with that. I mean, it's the industry that wants it, but I'm more interested in understanding long cycles, trying to write well, trying to have some tie-in with culture, and think of markets not so much as a separate thing, but very much as to a small but very important object in the social fabric. Does that answer your question?
That is a very interesting answer, and it reminds me, I was speaking at an event for CFA in the Philippines, and they brought together like 2,000 young university students. And I gave a presentation based upon CFA ethics called, 10 Ways Ethics Adds Value to You. And one of the students came up to me at the end of this presentation out of 2,000 students, and she said, I just want to thank you because I didn't realize that there were ethics in finance. And it really made me realize, like, the stigma and all that. And I think when I think about what you've said about two aspects, there's a place for people who understand history in the world of finance. Not everybody's keen on that, but I think I have a similar desire to really understand what happened in the past. So welcome to everybody who's like into history. There's a place for you in finance. And the second thing is that there's also a place for people who are not driven completely by money. I know in the world of investment banking and all that. You know, the young people want to get, you know, make a lot of money and all that. You know, we get paid well, but it's the joy of figuring things out and trying to understand, you know, has this happened before? And, you know, how do I think this is going to play out? And then, as you said, you know, writing that well and presenting that well. So I like your answer because I think it inspires, it can inspire many people who, you know, may think that finance is just, you know, money, which I think there's so much more. It's so interesting, you know.
Two thoughts on that. One, I don't know if you knew that before, but I actually teach the ethics session at I used to teach for the CFA Society in San Francisco, and I teach it for St. Mary's College. It's the first part of the curriculum, and it's on every level, and there's a reason for that. And then the second thought on you know, on making money versus gaining knowledge. I think at the end of the day, I think that's why I was intrigued and happy to join your podcast. Your podcast is, you know, knowledge is more important than money, and the silver lining from making mistakes is, you know, if hopefully you get a lesson out of it. The older you get, the more lessons you get, and I mean, truly, what I find fascinating about our industry is not so much the money. Again, you know, I'm on the research side, so this is not where people who are driven by money go. So let me put that there. But even so, what I find most fascinating is that we get to learn about so many things. I think in most careers, as you go in, you're in a silo, and the walls get closer and closer. You know more and more things about deeper and deeper about a smaller and smaller topic. And it can be, you know, a bit depressing over time. In finance is the exact opposite. I mean, this week, you know, we had to learn a lot about Swiss banking regulation and convertible cocoa bonds and AT1 capital. And, you know, the week before it was about what the hell does Silicon Valley Bank do? And what is a bank that doesn't do any loans?
Heard of this bank?
Yes. And, you know, before that, it was, you know, the impact of the Russian invasion on the supply on, you know, commodities that you may never have ever heard of, the chemical makeup of fertilizers. Before that, it was the Chinese reopening. I mean, this is really, I cannot think of another industry that is more suitable for a curious mind, where you just get to learn, and, you know, as you learn, you make mistakes, and yeah, great. You know, you make a mistake, you learn from it, and hopefully you share it with other people so they don't do the same.
When I talk to young people, I just basically say, you know, it's been 30 years I've been in the industry, and every day is still interesting, and, you know, stuff to learn. And like, that's what I wanted when I was young. There was a lot of other things, you know, I thought, you know, I want to have money and all that, but the main thing is that I really wanted to be able to feel like every day was an interesting day, you know, like, and I think I get that. I'm interested in something. I just want to highlight that we're talking on March 22nd. So maybe just that events are unfolding so quickly these days. So who knows what will change when this comes out. But I'm curious, you know, you've done a lot on inflation, and I've listened to some of the stuff that you've done, and you talked about the era of cheap capital, cheap labor, cheap goods. You know, I would add into that probably cheap oil, which may be, you know, part of that. And now there's kind of a reversal of that, but yet also when we look at inflation in the US, it seems to be coming down. And at what point do we decide, okay, inflation is over, or it's not? Or are we in a situation where inflation has come down, but hey, it's coming right back up because all of those things, and cheap capital, cheap labor, cheap goods, and maybe cheap oil, you could say are all going to reverse. I'm just curious where you stand right now on, let's just talk about US inflation for a moment, and then maybe we just expand it a little bit globally.
Well, so I like to make a distinction between inflation and CPI. They're not necessarily the same thing. I think I would like to think of inflation as a broader kind of social, political, historical phenomenon, and CPI is the tool that statisticians have developed. So I'm not claiming there's any sort of conspiracy or, you know, I don't see any nefarious hand behind it, but the concept of a thing and the thing itself are not the same thing. That's just a fact of how the world works. We create models of things because we can never see the thing, right? It's the and the CPI is a concept, it's a construct. I mean, it has some flaws, it has some good things, and so anyway, no story short, I do think the CPI is going to keep falling, in large part because of base effect in the commodity sectors. So, you know, we have oil at 65, the spike of oil when Russia, you know, it went all the way above 100. And you see that in nat gas and other prices. And I think that was a large part of the plan of the Fed, right? I mean, even if Fed hadn't raised rates, inflation would have fallen because of this base effect. We also have used car prices, which spiked a lot last year. And that's, although I'm not sure to what extent that will fully normalize. I would caution to expect it's probably not going to fully normalize, but across many quote unquote core goods, we had all these supply chain disruptions that are normalizing today. So yes, the CPI is going to fall. And then if everything goes fine towards the end of the year, what we should start seeing is shelter inflation, shelter commodity CPI to fall. And again, that's an issue of the construction of the CPI. There is a huge part that lags quite a bit. It's shelter about 33% of the index, rent 7%, and then owner's equivalent rent, which is a statistical construct that the Fed uses or the BLS uses to track the theoretical value of the rent that homeowners would pay themselves if they some crazy thing like that. So anyway,
what is the lag roughly on that? What's your estimate? Is that 6 months, 12 months? Or
yeah,
20?
so on rent, it's probably closer to 6 months. Again, that has to do with the timing of renewing the lease, right? So we had a big inflation spike, right? But you know, your landlord doesn't renew the leases every day, right? So it takes a few months for the rent. If you were to sign a new lease, you'd pay a lot more than you would last year. You know, it takes a few months for that to flow through. And then on the OER, it's even longer. It's probably more like 12 to 18 months. So let's say that the peak for the housing market was late 2021, maybe. Something like that, early 2022, that should get you towards late 2023 to start seeing that in the owner's equivalent rent. But again, what I'm describing at this point is just math, right? I mean, you know, base effect. Okay, so prices were higher last year, so on a year-over-year, that's going to change, and then so that's why I'm saying CPI is falling. CPI is falling. That I'm not questioning. I generally don't. I doubt it's going to fall all the way back to 2%. I mean, it's possible if we see very weak commodity prices, but my guess would be it kind of bottoms out at 3.5, something like that, 3.5.
Yep.
And then, yes, I would be in the camp to think that it will probably reaccelerate or certainly stay significantly above 2% for a sustained amount of time. And that is because I think inflation, if we understand it as a kind of broad social, cultural, economic, political phenomenon, is still there. And the way to measure that in CPI, it really wages to me. At the end of the day, inflation, you know, I would prefer we measure wage growth. And I mean, I guess you need price at the same time. But right now, what really matters for long-term inflation is wage in labor-intensive sectors. So when I look at the CPI reports, I don't look at the headline, the core, the trim mean. I mean, now we have so many versions of the CPI, you know, because everybody's trying to break it down and to the bit that fits your narrative. Well, I'm guilty of that too. The bit that fit my narrative is haircuts. I look at haircuts because I think it's a highly competitive. You know, there's no everybody can open a haircut salon, and really what you pay for a haircut is labor and a little bit of rent. So this is truly the underlying measure of inflation economy to me. Is you see that in haircuts. I mean, I say haircuts, but you could put laundry service, laundry, garage mechanics in garage, attorneys. What else would go in there? Childcare, and that. that bit of the core services in the CPI has been basically inflating by 6-7% for a couple of months. So it's no longer accelerating, but it's not stabilizing, and I would say it's a good thing. I mean, I would argue that the hairdressers haven't been paid a fair deal for a long time, and it's good that they get pay raises. And I don't see that any what's happening right now with the collapse of Silicon Valley Bank and venture capitalists crying for their money and private bankers in Zurich running like crazy people is really going to impact the price of a haircut.
And if we were to put it into the context that, in my case, I have a global strategy that's, let's say, stocks, bonds, commodities, gold. How do you look at those? And when I say stocks, let's say mainly I'm thinking global. Let's say US is obviously a big issue, but let's just say global. Does this mean that it's the commodity? I know in my case, I've reduced my commodity exposure over the last few months, and I've kind of given up on. I made a good performance on that, but I think at this point probably not worth it. Gold still seems to be worth it to be in the portfolio, and I'm underweight the US right now, and shifting that towards Europe and Japan. I'm just curious, like, how do you look at either those four asset class or the way that you look at investment strategy?
Okay, so you said stocks, and then when stocks, you
commodities,
global
gold.
bonds, commodities, gold. So I think my big view is that we are kind of a secular turning point where inflation is returning, and it's going to be more persistent, and at some point I think we'll just learn to live with it, and we'll abandon the fantasies of going back to 2%. And in a way, I think that is a good thing. There is no reason that 2% is a number we made up, and we should be able to adjust it if the conditions require to adjust it. So the implication, obviously, of higher inflation over a longer period of time is most negative for bonds, obviously. Now we've seen what I would say about bonds up until the events of the past 2 weeks. We've seen bonds reprice, especially in the front end. I mean, if you look at that US yield curve, I mean, it's moving like crazy. I mean, just what is it, like a month ago, we're thinking, we're going to see like, 6% Fed funds rate and 75 basis points was on the table. And so the short end of the curve actually looks quite attractive, but the long end, I think, was still kind of ugly. But bonds are repriced. Stocks, especially US stocks, they are not repriced all that much. I mean, yeah, we had a small bear market last year, but it was, by no means catastrophic. And we had a pretty good, bear market rally. I mean, we went up about the 200-day moving average. We're, go back to, about 4,000. So it was kind of hard for me to be very constructive on the US stock market in general, especially given its concentration in a handful of very long duration stocks that were very rate sensitive. Since I think long-term rates will rise and go, it's hard for me to be very constructive on the US stock market as a whole. Globally, I think one of the trend of the past 40 years, along with falling inflation, has been outperformance of US over the rest of the world, especially in the past 10 years. I think in each of the past 10 years, the US outperformed the world, MSCI World ex-US by more than 10% in each year. Particularly brutal for Europe, emerging markets. I kind of think that a lot of that is it's cyclical and it will reverse. We are actually seeing some of that since October. We are seeing better outperformance by Europe. Now, Europe, of course, the issue in Europe is we had this, the resurgence of inflation is not just a US phenomenon. If anything, it's worse in Europe because we have the shock from higher gas prices. I think emerging markets are really, depending what, of course, it's a broad category that dumps things together that may not make sense. But, places like Indonesia, like even Thailand, where you are, Brazil, like inflation is not new to these places. Like if anything, it's actually a bit lower.
Yeah.
You go in Brazil. I mean, I was there last week. I mean, 6% inflation, 13.75% on the Selic, the benchmark. So they already had their big adjustment in monetary policy, and now of course they're looking at cuts. So yeah, it could be that emerging markets end up, I think, on a regional basis. Maybe and again, also if you look at the composition of the indices, my concern is rates are going to go up, inflation. So you want a short-term duration. One issue with the US and actually China at the same time is the dominance of these mega tech stocks. You don't have that in a lot of emerging markets, right? It used to be BBC, banks, beer, cement, very short duration, kind of value oriented assets with a balance sheet of tangible assets, which of course has suffered dramatically in this era of low rates when people have valued intangible assets, things that may make a lot of money in the future. If we go back with shorter time horizon, because that's what inflation does, you will go back to the tangible asset investing, and that would include some emerging markets, which are not that affected. I mean, if you look at place like India, if anything, that means you get to buy oil at a 30% discount from the global prices. I mean, it's fantastic. This is a very unusual crisis. I mean, usually whenever you have a crisis, financial markets, I mean, it's always going to be, Indonesia is going to be there.
Yeah.
The rupiah is going to take a beating. The weaklings, right, or South African rand, or the vulnerable country. This is happening in Switzerland. Switzerland and California. So maybe it is this odd crisis that's not, the child book, the one is not like the others. One is not, this one is not like the others.
Which one of these things is not like the others? I remember that. It's interesting you mentioned about tangible assets maybe being more attractive nowadays. And I know in Europe, there's less tech and a little bit more tangible assets there. I'm curious, are you positive or negative on what's going on in Europe as far as equity is concerned?
I mean, well, Europe has got going a couple things. I mean, it's cheap. Now again, I ran a Europe product for 10 years, and I left because I ended up it's cheap. Yeah, it's cheap. Well, it's cheaper now.
So it's always cheap.
I was really happy when I picked the best European bank this year. It's only down 25%. So it's hard for me to be very excited about Europe. But what I will say, so yeah, it's certainly this big discount. There's a much greater leverage on China. I think for people who are not comfortable investing in China for political reasons or regulatory risk, one way to get your China exposure could be to get it via the DAX, which essentially is a leverage bet on the Chinese reopening. I mean, we're supposed to freeze to death this winter, so that's our benchmark. Going with the idea of the worst investment, like if your expectation is to die, pretty much anything beyond that is a win. The only, and that is a big but, the only caveat is inflation is at 10%, and the ECB is way behind the curve. So that rate shock, which in the US you may make a case that we're closer to the end than we're at the beginning. In Europe, it's unlikely, and never discount the stupidity of European policymakers. Like they will always, there is tradition for European Central Bank to do one last rate hike at the worst possible moment. So that would be an issue for valuations in Europe. And we do have a banking sector. I mean, we hadn't monstrosity. I mean, we had negative yields for since 2015 for the ECB, a little earlier for the Riksbank in Sweden. We had a 1.18 trillion worth of bonds with a negative yield. The vast majority was in Europe, a little bit in Japan as well. I mean, somebody's got to own these. They're somewhere. I mean, a lot of them are on central bank's balance sheet, thank God. But I don't think that's the only. Banks, insurers, and the pain of repricing something from a yield of -1% to, let's say, +4%.
And it's
I mean,
long duration.
yes. So,
So, I
if you
mean,
have,
we're talking about 30, 40% crash in the value of those.
yes. So basically what took down SVB, having, 30-year duration and a 200 basis point shock. So you lose, 60% of, I suspect it's there. And, SVB didn't hedge, but I mean, I doubt that people, I'm not sure that everybody was hedged either. So
Yeah.
I suspect there will be more ghosts coming out of Europe in the financial sector.
Yep. One last thing I wanted to tell you about was something I wrote about a year ago, and over 6 months ago I kind of updated it, and I said that that World War 2.5 just happened. And
Well, 2.5.
2.5, it wasn't 3, but it just happened.
So the 0.5 refers to the use of nuclear weapons.
And yeah, we get that, then we're at 3.
We're at 3. Okay.
Yeah. But it was the US against who? That's what I always say to my clients when I'm talking. I say, and they say, oh, US against Russia. And I say, no. In fact, Russia is kind of meaningless in some ways to the US. It's not economically a real threat. It's not even militarily a real threat. China? No. Now, the key thing is in World War 2.5, America won. And World War 2.5, in my opinion, sitting from Thailand, looking out at the world, is US versus Europe.
Yeah, I mean, hey, they blew up a pipeline.
Yep. And the significance of the cutting of the supply of oil from Russia to Europe is just cannot be understated. It is such a huge, move.
Okay, actually, you know what? I would agree with the 0.5 on that, because my initial pushback was that to be at a war, it takes 2. Like, you cannot have a war alone. Because I can see the US attacking Europe. I don't think so. That maybe that's where the 0.5 comes from, right? It's that there's only one belligerent in that war. The only one is the victim. But so
I think of Genghis Khan coming across, across the steppe and approaching and destroying city after city, and he approaches the city and says, either surrender or I'm going to burn down everything and destroy everything. And I thought many of those cities just thought, okay, easier just to go with the flow here.
Yeah, that's the unfortunate. I would agree with your assessment on the war. Is the I mean, at the end of the day, you look at it, for the kind of great game, real politic view. I mean, the US it's a good deal, right? I mean, they'll fight it to the last Ukrainian, right? They in the opposite situation as in the Vietnam War, where they in the Vietnam War, the Chinese and the Russian were helping the Vietnamese kill American soldiers. Today, all they have to do is send them money and have the Ukrainians die for them. Defang the Russian army. That's a good deal. They're energy independent. If anything, that means that indeed European demand is diverted. What used to be Russian through pipelines now is LNG, mostly from Qatar and in the US. So the US is I can keep doing that. And then the rest of the world, China, India, it's like, well, we get cheap oil out of this. So really the only losers outside of obviously the Ukrainians and Russians who are dying are Europeans. I think that's
and the question I got is why does America need to do that? And my answer is because America stated very clearly that their number one opponent is China. And what we can see in the global South in particular, and countries like Thailand and India and others, is that they're not going along with America. And so the only place that America's got to get Europe under its control when it starts really.
That's what blowing back Nord Stream 2 was, right? It's like, it's no return.
Yeah.
Even if Germany wanted to, and then I never believed that was a serious threat, but basically Russia and European reconciliation and the you know the but I think in the US um that was a fear, like the kind of a hardcore like Trump or even Peter Zeihan type of guys that Europeans are going to backstab us and the Germans are going to basically like they export more to China, and China used to became Germany's biggest trade partner. So you sell your stuff to China, you buy the cheap gas from Russia, and then you don't pay for your defense because you're protected by NATO. I mean, you're really getting the better bargain here, and they want you to clamp down on that, and do it irremediably so. And I think it succeeded. Like it's very hard to imagine. I mean, I guess anything is possible. Get a peace deal and stuff, but at this point, it's the amount of bad blood that was spilled between Russia and Europe is going to be hard to recover. And again, the infrastructure has been taken care of now. So even if we wanted to, there's no pipeline left.
All right. Well, I really enjoyed talking to you about these things. I think there's a lot that we can all learn. I was taking a lot of notes about what you were saying. And so I appreciate it. But now it's time to share your worst investment ever. And since no one goes into their worst investment thinking it will be, tell us a bit about the circumstances leading up to it, and then tell us your story.
Okay. So the circumstances were great financial crisis, summer of 2008. I just started working, just started investing, and yeah, in the fall of 2008, I mean, I remember just day after day, the 30-year yields dropping and dropping. It was stable at 5% for it. It seemed to me that 5% was the right number, right? 2% growth, 2% inflation, 1% term premium. It was one of these numbers, maybe in the CFA is where I learned it. It's like, oh, dividend discount model, like you put. To me, that was it, right? The long-term risk rate is 5%, and then in a matter of week, I see the 30-year fall to I think it went all the way to 2.5 in the depth of the Lehman panic. And that makes no sense. Like, I mean, you see a 250 basis point move in a matter of a week. I'm gonna fade that. I'm gonna buy TBT, pro share, ultra short treasury, long end. So you're on the long end, so you already have built in that. We're talking about duration, right? So I think the duration on that baby is around like 20 years, right? So every percent move, you're gonna go 20% in there, right? And then you're adding some leverage to it. So I was like,
and let me just try to explain that for the people who aren't necessarily sophisticated in the investing side. The interest rate went down, which meant that bond prices went up. And you were saying to yourself, that's just too high. Bond prices are too high. Interest rates are too low. And I think that's going to reverse. Is that what you're saying?
Yes.
And therefore you're taking on a position to say, okay, this is going to reverse. And you're doing that through an ETF that gave you access to shorting US Treasury prices.
Correct. And then, the hard thing about my mistake is that it worked at the beginning. And I think these are the worst kind of mistakes, because like if you put on a trade and right away it blows in your face, I mean, you're like, all right, I'm a moron, let me
get out of this.
And I'll
like I just did with financials.
Never tell anyone, but like, then you have some emotional capital involved. Oh, I'm smart. Because indeed, my case was kind of right. Like it was excessive, that move to 2.5%. And then after that, with QE and, eventually the economy came out of recession, the yield curve steepened. And so I was up big. But I thought it would go a bit higher. I thought it'd go back up to, it'd go back to that 5% range. So I didn't sell. So there were really two mistakes there when I went back. One was the choice of the vehicle. I mean, leveraged ETFs are, they're trading non-investment vehicle. And I was, if I had just made a trade, I would have made a lot of money, but I got a trade and investment confused, and I had a trading vehicle for which I held. So because of the nature of leverage ETF, I mean, it's compounding, right? If you go down by 50%, you need 100% gain to go back up. So leverage works again. There's a variance rain, if you will. The more volatile something is, the more likely over time it is that it will lose its value. So if you plot any leverage ETF, regardless of whether it's leverage oil or leverage volatility, whatever, they all trend towards zero over time, and that's by design. It's not a conspiracy. It's not a. It's just you have to keep rolling all these contracts, and sometimes you also have some roll costs, so they are not something to be held for the long time. And they say that in the prospectus. And I guess I knew that. I just thought, like the lottery guys, oh yeah, it's not gonna happen to me. I don't know why. So there was that. There was using the wrong vehicle, and then I think the more important question was kind of confusing a trade, trade with an investment. Basically, you had, it was a massive counter move, and I played it right initially, but it was a counter move. The trend for rates at the time was lower. We had no inflation. We were going to have QE. The central banks were going to monetize trillions of debt and move to the long end. And I was fighting the Fed effectively by shorting bond. You're fighting the Fed. It's like, whoa, the Fed just announced, 4 trillion, over the next decade, the balance sheet would grow from, maybe 1 trillion before 8 to 9 trillion. And I'm the idiot fighting against that. I mean, there's literally someone with a printing press against me. I'm like,
but I'm really confident.
Yeah, I'm going to short the asset that you're buying. So yeah.
And how did you get it? How did you end the position? How did you close the position?
In shame.
I
mean, I probably lost, eventually I kind of gave up, like, hey, okay, I lost, because I lost on the fact that rates went down. Although, again, it was not I bought it at the right time. So I didn't lose too much on the rates, but it was the variance drag, the little thing that I was describing before, like the fact that with a leverage ETF, just because the swing, you end up with kind of a down. So that's what really got me. And I think, I lost like 60-70% on it. And sold it for the tax loss and reminded myself that I could be an idiot.
It's good to make these mistakes when we're young, because we don't have we're not putting $1 million down on it. So that's the one good part. How would you describe the lessons that you learned?
Again, the lesson really goes back down to trade versus investments, and kind of understanding the period where you're into. It's kind of this mix of cyclical versus secular, and I think that ultimately that's kind of what I confused. So what I thought was okay, so there was a cyclical move, right? We had this panic.
Yep.
Bond prices went through the roof. It was excessive. And there was going to be a counter reaction. And that I got right. The problem is the counter reaction was within a secular environment of falling yields, falling inflation, central bank environment. And I should have taken that into account into my analysis, just instead of just, oh, it's too low. Yeah, it is too low. And it's going to bounce. Yeah, it's going to bounce, but it's not going to bounce back to before. It's not going to return. Well, we're not going to return to 5% plus 30-year yield. We're still not there, by the way, even 30 years later. Like, the environment really had changed, and I didn't see that. So it's also in terms of, I think, getting an exit. So you find it was market dislocation. You find rational pricing. Great, good for you. Take the position, but have a plan to get out. I didn't have that.
Right. So maybe I'll summarize a couple of things I took away. I mean, the first one is probably for most people, it makes sense just to avoid leverage. It can be useful at times, but generally it's probably not. For the other thing, it's interesting, you talked about good idea, wrong vehicle. When you get an idea about a trade you think makes sense, think carefully about how you're going to execute that. And does this really give you, you know, you mentioned something earlier as an example of this, like maybe investing in, you know, German manufacturers is a play on the recovery of China. Well, recovery of China is a good idea, and this is one vehicle to do it. Is it the right vehicle? I think that's a question that is not that commonly asked. So I think that's a good one. The other one that I wrote about, I wrote down when I was taking notes, was be careful about treasuries and also Forex, because basically you're fighting against the Fed. You're fighting against banks with a huge balance sheet, and you're fighting against an unlimited buyer who can move in any direction without any, you know, without any warning. And that leads me to my last thing is, and I wrote this down about what you said about European bureaucrats. And I just said, don't overestimate the genius of Fed and other bureaucrats to just go and do something very, very extreme or wild, like keeping interest rates at basically zero for 30 years. You know, who would have thought that they would have done that? And so those are some of the things I take away. Anything you would add to that?
No, I think you really summarized it well. And I mean, the one thing I would add is the psychological aspect of it. Of that, I think that's really what got me, is the hubris of having the trade work at the beginning, and you know, and remember, like, this was a way, right? I mean, this is like the world was falling apart, and I thought, wow, this could be my George Soros breaking the Bank of England trade type of thing. Like, why? You know, I'm making this. I hear, you know, I'm like 20 something, right? And I'm trading from E-Trade. Okay, this is my PA, and this is not client stuff, unfortunately. You know, and I'm like, why the hell, as a 20 something, I was like, and I put a significant amount of my PA in this, you know, on the leverage ETF, on treasuries, and then it goes my way, and I'm validated, and I think it increased my confidence. I should have done the exact opposite, right? Instead, if I had been wiser, I'd have been, okay, I got the counter move. You know, my case, you know, again, the more you make money, the more your case is validated. So my case was valid at the time, you know, when yields 30-year yield touched 2.5%. It was stupid. It was panic. Yes, that was true. Inflation will come back, growth, all that. But like, when we're 3.5, like, that's it. The world had agreed with me, but I wanted more.
Yep. So let's go back in time and think about yourself, as well as the young people listening to this podcast, and try to think about them kind of coming up with their idea, which is a smart idea. You know, you've thought about it, you've studied about it, you're relatively young. Based upon what you learned from this story and what you've continued to learn, what one action would you recommend they or our listeners take to avoid suffering the same fate?
I mean, sizing of the position is important. I was okay, you know, at the beginning of my career. But I at one point it was probably like, you know, 30 to 40% of my I think I did it in my IRA, my retirement account too, which is like, what the hell was I thinking? You know, I mean, I was really, so, because that thing, the underlying is I think long swaps on 30-year treasuries. Why is that? Like, you know, why is that a valid investment? You know, why did I have 30% of my retirement savings in this? Now, hopefully, fortunately for me, and I think that is maybe the lesson, you know, when you're young, you can make mistakes. Like, you know, I had another 20 years to invest my 401k in a smarter way. So I guess my answer would be making mistakes when you're young. And then, because you can't really avoid them, right? I mean, like, you know, we all do make mistakes. I think as with age, we just become more prudent in how
we have an accumulation of mistakes. So we've built some knowledge.
So we have some, all right, you know, I think I'm really smart right now. This is okay, but I'm not gonna go 100 on anything, right? So there's that. And then don't let yourself get beaten down too with mistakes. I mean, we all, they're learning experience, and I mean,
let's wrap up. One of the things I just want to ask you about as a resource. I know you've got your global macro reports. Maybe you could just tell the audience, what you've got and what you're doing there, so that if they're interested in learning more, they can go. And I'll have a link to that in the show notes.
Sure, wonderful. So I write weekly reports for StoneX. So StoneX is a global financial firm. We have Fortune 100 companies, offices pretty much everywhere in the world. We serve primarily, my reports are sold to institutional clients.
Yep.
So the way people can get them is they trade with a firm, and then they get in touch with their StoneX rep, or because of regulation in Europe, we actually have to unbundle the research and the execution. So it's possible to subscribe to my work. I think it's quite very, very competitively compared to it's an institutional product, but compared to other institutional products, it's actually very reasonable. 4 times a month, I try to write about things that people don't really think through. I try to avoid, press release or earnings guidance or PMI or data. I try very hard to think about risks that people may have missed and things that are overlooked. I mean, we have a very gregarious industry, so there is a lot of room for that. If you go to my Twitter handle at Vincent Vincent Deluard Deluard at Vincent Deluard on Twitter, under my pin tweet, there is a link, and you can sign up. You'll get a 2-month free trial of my work. Then I'll get in touch with you. We'll see if we can turn that into an ongoing relation, or just DM me. Like I love Twitter. I've met some fantastic people on Twitter. People were very kind to me on Twitter, and I try to return that by being kind to people who reach out.
Fantastic. Well, we'll have links to that in the show notes to both your Twitter as well as the free trial site. So last question, what's your number one goal for the next 12 months?
Personally, or like for
whatever you want to share. Personally is interesting. Professionally is fine.
Number one goal. So I'm gonna go with a personal answer. I mean, I'm about to turn 40. My dad just passed, and I'm going through this kind of moment of soul searching. I'm not immortal. I have half of my life most likely behind me. What do I want to do with the next half? And what is it that matters to me? I think for a lot of people, we try spend a lot of time trying to be good for other people, for parents, for teachers, for the boss, and at some point you realize that you get caught in doing things for other people, that's probably what a midlife crisis is. And I hope I do not solve it by buying a flashy red car and getting some hair implants, but in a way that is a bit more meaningful.
Well, I know that feeling. I lost my father 6.5 years ago, and it really did make me think, okay, my time's limited. What contribution do I want to make? So that's an exciting journey. You're going to learn a lot. So listeners, there you have it. Another story of loss to keep you winning. Remember, I'm on a mission to help 1 million people reduce risk in their lives. If you've not yet joined that mission, just go to myworstinvestmentever.com and join my free weekly Become a Better Investor newsletter to reduce risk in your life. As we conclude, Vincent, I want to thank you again for joining our mission. And on behalf of AE Stotz Academy, I hereby award you alumni status for turning your worst investment ever into your best teaching moment. Do you have any parting words for the audience?
No, thank you. This is a lot of fun. I enjoy your style, your conversation. This was very fun, and I like your humility, and I think we all need some of that. So thank you.
Well, we appreciate your authenticity on this show. And that's a wrap on another great story to help us create, grow, and protect our wealth. Fellow risk takers, let's celebrate that today we added one more person to our mission to help 1 million people reduce risk in their lives. This is your worst podcast host, Andrew Stotz, saying, I'll see you on the upside.